Friends, welcome. Few more concepts of auditing we are going to discuss. One is very important concept, that is about audit materiality. That is relevant in every auditing decision. That is one thing. But prior to that, one more, again, important concept, that is preconditions of an audit. Precondition means before accepting or before commencing the audit, auditor is expected to ensure that whether these preconditions exist or not. If preconditions, let us say, do not exist, then it is very difficult to commence the audit. And even if somehow audit is conducted, then it is again difficult to express an opinion on that. So let us see what is the meaning of these preconditions, how that is relevant to an auditing activity. So for that thing, if you refer to SA 210, the title of that standards on auditing is Agreeing the Terms of Audit Engagement. So as per that auditing standard, as per that standards on auditing, precondition of an audit may be defined as the use by management of an acceptable financial reporting framework in the preparation of the financial statements. So friends, you are already aware of what is the meaning of financial reporting framework. Yes or no? We had discussed this earlier in a very important concept, because many times when we be discussing various concepts about auditing, we'll be using this phrase, financial reporting framework. Okay, what is that financial reporting framework? Again, for your benefit, I'm explaining you through this slide. And you must be knowing that the financial statements are supposed to be prepared in accordance with the financial reporting framework. Now, what is that? A financial framework is a set of criteria which is used to determine measurement, recognition, presentation, and disclosure of all material items appearing in the financial statement. And you know, in the financial statement, various items are appearing. They do appear. And how they are measured, how they are to be recognized, how they are to be presented, and how that is to be disclosed are determined by this set of criteria. And it is the duty of the management to ensure that the financial statements are prepared in accordance with the financial reporting framework. Okay, and it is the financial reporting framework which sets out the concepts that underlie the preparation and presentation of the financial statements. So that therefore, whenever a financial statement is prepared, this financial reporting framework needs to be considered. And in fact, the financial statement reporting framework, in fact, the financial statement has to be prepared strictly as per the requirements of financial reporting framework. Okay, and in case it is not so, then auditor may give a disclaimer or may give a adverse opinion also. It will definitely not show the true and fair view. Okay. Now, friends, what we are talking about right now, about preconditions. Okay, what are these preconditions? The use by the management of an acceptable financial reporting framework. Whether the management is using an acceptable financial reporting framework or not in preparing the financial statements. Let us say, Companies Act 2013 says that for this company, you have to prepare the financial statement in a particular format. And it is not prepared in this format. Now, can you say the financial statements are prepared in accordance with the financial reporting format? What do you say? Can you conclude that financial statement is prepared as per financial reporting framework or not? Are you getting my question? I said the Companies Act 2013 requires that the financial statement has to be prepared in this format. And there is a company who has prepared it in a different format. Now, what is your conclusion? Whether financial reporting framework has been followed or not?
No, sir.
No, it has not been followed. Okay, so this is an example of a situation. Yeah. Okay, that means management has not used an acceptable financial reporting format. Management may be preparing in some other format, but that is not acceptable. Okay, and the second part of the definition says, and the agreement of management and where appropriate, those charged with governance to the premise on which audit is conducted. That means whether the management and people who are charged with the governance of the entity, whether they are agreeing to the audit premises. That means in the circumstances where audit is to be conducted, whether they are agreeing or not. Okay, so that is the precondition. That means in precondition, suppose we want to assess the audit precondition, first of all, we have to see acceptability of the financial reporting framework and agreement of the management to the audit preconditions, or agreement of the management to the audit premises. If these two are okay, then you can say preconditions exist. Now, how to know whether preconditions are present or not? So we may, as an auditor, one may test all these things. For example, determine whether the financial reporting framework is acceptable or not. So the way the financial report has been done, the way it has been recognized, measured, presented, or disclosed, is it acceptable? If the financial reporting framework requires some disclosures has to be there, and if it is practically not there, that means it is not acceptable. Then again, often the agreement of the management that it acknowledges and understands its responsibility. Okay, this understanding of responsibility and this understanding of management's own responsibility is a major part of premise of audit premises. In that premises only, audit has to be conducted. So auditor need to obtain an agreement of the management that it acknowledges and understands its own responsibility. And what is the responsibility? That includes, it has got some responsibilities for preparation of the financial statements in accordance with the financial reporting framework. So management should agree to it. Management should understand it, and management should also acknowledge it. Also, management responsibility includes internal controls, as management considers is necessary. To the extent it's required, to that extent, internal control systems should be implemented. And also, management should provide the auditor three things. First of all, access to all information, such as records, documents, and other matters. Auditors should have access to that. Additional information that the auditor may request from the management for the purpose of audit. If the auditor is requesting something, management should provide that. And also, management should provide unrestricted access to the persons within the entity from whom the auditor determines it necessary to obtain evidences. Suppose auditor feels that the evidences is available available with a particular person. So management should give access, unrestricted and in fact unrestricted access to the persons. That means management should clearly give this access to the auditor that anytime the auditor wants for this purpose, correcting of audited evidences, he may meet that person. That is what we call it is unrestricted access to the person within the entity from whom auditor determines it necessary to obtain audited evidences. Are you getting? So all these points are talking about premises in which audit is to be conducted. First one part is the financial reporting framework. Okay. So auditor has to here see that whether it is acceptable or not. It is acceptable, okay. The next part is that whether management is agreeing, acknowledging, and understanding its own responsibility. What is that responsibility? To prepare the financial statement in the financial reporting framework. Number one. Number two, its own responsibility as regards to establishing an internal control system, which is appropriate. Point three, its responsibility to provide the auditor access to all information, additional information, whatever is demanded. Then unrestricted access to persons. Okay. If these things exist, you can say preconditions for an audit exists, audit can be conducted. Okay. Okay. Now, preconditions of audit concept is over. Okay, one more small concept we'll be discussing. This is the concept. This concept is the limitation and scope. Earlier, friends, we have already discussed what is the scope of auditor. But what is going to happen if there is a limitation in the scope? Okay, or the client imposes a limitation. Then you can do audit, but subject to these conditions. Or something for certain evidences, access will be given to you, but some other evidences will not be provided to you. If management comes with this type of conditions. Okay, how that is dealt with. So now if you read the paragraphs of the standards and auditing, it says, if management or those charged with governance impose a limitation on the scope of auditor's work in terms of proposed audit engagement, such that the auditor believes the limitation, such that the auditor believes the limitation will result in the auditor's disclaiming an opinion on the financial statement, then what will happen? Okay, let us understand it up to this stage first of all. Here it says the management has imposed a limitation on the scope of it. An auditor believes that this limitation will result disclaiming an opinion. For example, let us say management says, okay, you do your audit, but I will not show you my sales register, sales invoices. So it's a limitation on the scope. Okay, it is very much within the scope of auditor. The auditor can verify that thing, but management is refusing, will not give those documents. And since it affects the entire sales, and it has a pervasive impact on the entire financial statement, so there is a possibility that auditor may not be able to express an opinion. In that situation, auditor may disclaim or give a disclaimer that I am unable to express an opinion because of these limitations. So if auditor feels that audit he can conduct, but there is a limitation on the scope, a limitation is so huge that it will have some pervasive effect, and for which he has to give a disclaimer. Then what he can do? Ideally, he should not accept that. Are you getting? Let me show you the paragraph again. The auditor believes the limitation will result in the auditor disclaiming an opinion. Auditor disclaiming an opinion means auditor is unable to express an opinion. The auditor shall not accept such limited engagement of an audit engagement normally. But in which situation it can accept? If it is required by law or regulation also. If there is a legal requirement, but law says the auditor has to accept this engagement. Then he can accept. So normally auditors shall not accept unless it is required by law, regulation to do so. Okay, in that situation, auditors should not accept. Did you understand? Now you may be thinking, in case precondition doesn't exist. So one thing is that appropriate decision will be not to accept audit. What the auditor can do? First of all, auditor may discuss these issues with the management. Okay, and unless the required law or regulation insist auditor, then auditors shall not accept the proposed audit. But if there is a requirement under a law or regulation, then auditor may accept. Okay. Now, if the auditor has determined that the financial reporting framework to be applied in preparation of the financial statement is unacceptable, that is, it is prepared in such a way that which is different from the framework which is prescribed by law, or if the agreement referred in paragraph 6b and there 6b were discussed has not been obtained. What is that agreement? If you see the 6b, it talks about, okay, this is that agreement. Often agreement of the management that it acknowledges its responsibility. That means what we are talking about, that if the financial reporting framework is not acceptable, or the management is not understanding its own responsibility, then you can say precondition of audit doesn't exist. And unless required by law and regulation, auditors should not accept that. So that part is clear here. Okay. Now, friends, in this context, also we need to understand. Now, one thing I told you, or we are discussing, that the financial statement has to be prepared in such a way that it is in accordance with the financial reporting framework. Now, why it is necessary? Because then only it can show true and fair. Right. So if you refer to section 121(1) of the Companies Act 2013, it says that the financial statement shall give a true and fair view of the state of affairs of the company or companies. That is one thing. It has to give a true and fair. And it should comply with the accounting standards which are notified under section 133. That is one more thing. And shall be in the form and forms as may be provided in different class or classes of companies in Schedule 3. So this is the basic requirement. One is financial statement has to give true and fair view. And it has to comply with the accounting standard. It shall be in the form which is prescribed in the Schedule 3. All these three things should happen. Okay. Understood? Is it okay? Right. So this is, or you can say, these are the issues which has to be considered as preconditions of an audit. An auditor in this situation has to deal appropriately. If the preconditions of audit doesn't exist, auditor may refuse to accept that. Now, friends, one more concept again we are discussing. This is about concept of materiality. Okay. This concept is often discussed in various areas in the context of preparation of financial statement, also in the context of uh, presentation and also in the context of audit. Okay. And although the financial reporting framework may discuss the materiality of different terms, but generally what it means, let us try to understand that. How you know particular item is material or not. Now, it is extremely important for us to remember or to understand these 3 points, because on that basis we'll be discussing about materiality. First of all, let us read it. Misstatements including omissions that are considered to be material, if they individually or in aggregate could reasonably be expected to influence the economic decisions of the users taken on the basis of the financial statements. Okay, what we are talking about here. If there is an item and if it is misstated, suppose there is a particular item, there is a particular figure which is misstated or it is omitted, whether it's material or not, how will know? If the individually such item or these items when considered with relation to some other or considered in aggregation with some other item. If they are in individually or in aggregate, could reasonably expect it to influence the economic decisions of the users of the financial statement. So if it is affecting the economic decisions, suppose for example, one person was planning to invest money in a company, and because there is a misstatement in the financial statement, he is not investing. Is it affecting his economic decision? I repeat, there is a misstatement in the financial statement, or there is an omission in the financial statement. And because of that thing, the person who is supposed to invest in the company are not investing in that company. So it is definitely affecting the economic decisions of the user of a financial statement. When it is affected, you can say this item which is misstated or which is omitted is material. Okay. But on the other hand, if let us say a particular item is omitted, but it is not affecting economic decisions, that's very small omission. Then you can say, okay, item omitted, fine, but it may be error, it may be fraud also, but it is not material. Why it is not material? Because it is not affecting the economic decisions of the users. Okay. Right. So to what extent the economic decisions of the users are affected is a critical factor for understanding the concept of materiality or for assessing the materiality of that. Okay. Understood? Now, next thing which affects the materiality is the judgment about materiality are made in the light of surrounding circumstances and are affected by the size or nature of the misstatement or combination of both. So, in the context of the surrounding circumstances, one has to see whether it is material or not. For example, if the company's turnover is very high, or the balance sheet position is very high, but small misstatement in the turnover figure may not be material considering the size and nature of mistake. Okay, suppose a particular sales transaction is not entered and the amount is only 500 rupees and company's turnover is 5 crore. In that, in a 5 crore turnover, if 500 rupees is missed out, then considering the size and considering the nature of misstatement, let us say it is an error. It's not a fraud and it does not indicate possibility of a major fraud. So that is what we are considering the size and nature of mistake. But it's a mistake. But in the given circumstances, these misstatements are not material. So whether an item is material or not, we have to understand, keeping in mind the surrounding circumstances. And these judgments, the judgments of materiality, are to be based on the consideration of the common financial information needs of the users. What is the need of a common financial information of a normal user has to be taken into consideration to judge whether item is material or not. Okay. So auditor also needs to decide, as the management also needs to decide which are material or not. For that thing, you have to see that is it affecting, that means whether this misstatement or omission is affecting the economic decisions of the user. Okay. And is it material keeping in light the surrounding circumstances? Or is it material considering the common financial information needs? Okay. So considering all these things, one has to decide whether item is material or not. As an auditor, what is its concern? Auditor is primarily concerned with the items which either individually or as a group are material. So the concept of materiality is important for the auditor because auditor considers whether item is material or not. And his opinion is to be based on the material items. Okay. There might be some error, there might be some error, fraud, but auditor still can give his opinion that it is showing the financial statement is showing true and fair view if the error or fraud or the misstatement because of this error and fraud are not material. Okay. So it is in fact quite difficult to assess whether it is material or not. Okay. And there is also no definite standard on the basis of which you can decide whether item is material or not. Okay. One key rule or one thumb rule we have to keep it in mind that if the item influences the decisions of the users of the financial statement, that is always material. But auditor judges all this thing or takes a decision on materiality on the basis of his professional experience and judgment. On that basis, auditor tries to conclude whether the concerned item is material or not. So, since auditor decides it on the basis of professional judgment or his experience, you can say it is a matter of professional judgment. And the concept of material is affected by the perception of the auditor. Okay. So auditor will perceive that whether this particular misstatement is influencing the economic decisions of the users of the common users of the financial statement. On that basis, we'll see this misstatement is material or not. Okay, and when applying that principle and when considering whether this particular misstatement is affecting the auditors, is going to affect the economic decisions of the users of the financial statement or not, what is expected? It is expected that the user is already having reasonable knowledge of the business. That means user is knowledgeable, he is having reasonable understanding of the business. And on that basis, he can decide, he can judge the materiality. Okay, if the if the users do not have the reasonable knowledge of business, then it will be very difficult to find out whether his economic activities will be influenced by this decisions or not. Auditor can also assume that the that the users understand the financial statements and users are able to appreciate the way it is presented and what is contained in the audit report or the content of the audit report. Okay, and users also will be able to understand the concept of materiality. Okay, auditor can also assume that users recognize the uncertainties inherent in the measurement of the amounts based on the use of estimates, judgments, and the consideration of the future events. What does it mean? That means auditor is assuming that the users of the financial statement recognizes the uncertainties. So when the financial statements are prepared, it involves some uncertainties because some figures are coming because of some estimates, judgments, and taking into consideration few other factors. Okay. And the users of the financial statement do recognize that. Therefore, they are in a position to take a logical decision. Okay. If they're capable of taking a logical decision, or if the auditor assuming that the users of financial statement can take logical decision, then auditor can conclude that whether a particular misstatement is affecting their decision or not. If it is affecting, that is material. If it is not affecting, it is not material. Okay. So the last assumption is that users can make reasonable economic decisions. If they make unreasonable economic decision, then that's a different thing. Then we as an auditor will not be able to assess whether the item is material or not. Because their economic decisions can be affected by immaterial things also. Okay. And for an auditor, the concept of materiality is important at the planning stage and also at performance stage. Why at planning stage? You have already seen how a detailed planning is necessary. And when auditor does a detailed planning, he has to ensure that all the items which are material are definitely audited or definitely verified. So planning stage auditor needs to consider materiality. And at performing stage, when auditor is performing, depending upon the materiality, he has to draw a conclusion what kind of evidence is required. So at the performance time also, materiality concept is important. Okay. It's also important in evaluating the effect of identified misstatements. If there is some misstatements, okay, what is the effect of that? Okay. To identify that effect, one has to use the concept of materiality. Whether the effect will bring some material change or not. And finally, when auditor is expressing an opinion, at that time also he has to use the concept of materiality because on that basis he will be concluding. And auditor is supposed to give opinion only on the material items. Therefore, the concept of materiality is applied at the planning stage, performing stage, evaluating the effects of misstatements, and also at the time when opinion is formed. Right. Friends, you have already seen the audit program. That is a part of audit planning activities. And when the audit planning is done, right, then auditor makes judgment about the size of the misstatements. That will be material. That means what size the misstatements of which size will material, or just keeps that thing in his mind. Suppose a particular, let us say I'm checking cash vouchers. The cash voucher, which item is, what is the size of item which is material. Suppose as an auditor, I feel transactions of 10,000 is material. So I will design the audit plan and program in such a way that more attention will be paid to these material items. Okay, and auditor will be able to form a judgment by checking those material items. Okay, and this judgment of materiality will provide the auditor a basis for determining the nature, timing, and extent of risk assessment procedure. For example, let us say auditor finds this particular area is material. Then he will be assessing the risk maybe on 100% of the transactions. He will be applying the risk assessment procedure on 100% of the transaction because item is material. But if you feel it is not that material, then auditor may, while determining the nature, timing, extent, and risk assessment procedures, auditor may apply it not on 100% of transaction. May apply it, let us say, only on 20% of transaction. Okay, so this judgment of materiality affects the determining the nature, timing, and extent of risk assessment procedures. Also, this materiality concept provides a basis for identifying and assessing the risk of material misstatements. Okay, if there is a material misstatement, okay, we understand there is a material misstatement in this area. But auditor, when auditing, also assesses what is the possibility of material misstatement in that area. What the risk of material misstatement? Is that risk tolerable? If it is tolerable, then he may not do 100% checking. But if it is not tolerable, if it is within his tolerable limit, which auditor also fixes in a program, then he may go for a deep or detailed examination of all these studies. Okay. And the judgment of materiality is also helpful in determining the nature, timing, and extent of further audit procedures. So friends, in an auditing engagement, auditor applies some risk assessment procedures and further audit procedures. We'll be discussing all these things in detail when we are going to learn audit procedures. Okay, right now we are understanding some concept. But right now, let us understand this first, that the concept of materiality, judgment of materiality, affects the risk assessment procedure. It also affects the further audit procedures. Okay. Okay, friends, I think you got the importance, got the how this concept of materiality is important. Right. Okay. Now, there is one concept of this performance materiality. Let us understand what is the meaning of this term. It means the amount or amounts set by the auditor at less than materiality for the financial statement as a whole to reduce to an appropriately low level the probability that aggregate of uncorrected and undetected misstatement exceeds materiality for the financial statement as a whole. This sentence appears to be complicated. I have made some attempt to break it into pieces. Let us try to understand it right now. We are talking about performance materiality. First, it talks about the amount or amount set by auditor. So let us assume something. Let us say auditor has set an amount of 5,000 is the materiality level. Okay, that means if some item is less than 5,000, it is immaterial, even if something is wrong in that. And that materiality label is set by the auditor for the financial statement as a whole, for the entire financial statement, whether it's a profit and loss statement, whether it's a balance sheet, or it's a cash flow statement, whatever may be. Materiality label set by the auditor is 5,000 rupees. Okay. Okay, are you getting me? Now, once that is set, in case there is, let us say, because you have set a materiality label and you have ignored the transactions lower than that, there is a possibility of undetected misstatements. Auditor might not have detected because auditor's program is for material items. Then auditor needs to reduce the probability that uncorrected and undetected misstatements exceeds the materiality of the financial statement as a whole. Some errors, some products are undetected, but the effect of that thing is not substantially affecting the financial statement. Okay, are you getting? That means let us take an example for this. Let us say in an audit we have said the materiality level is 5,000. Accordingly, audit program has been drawn up. Audit has been planned. Okay, since auditor is not seeing all transactions, he is seeing only material transaction. So auditor may ignore those transactions or may not pay adequate attention to those transactions which are below 5,000. Because for the entire audit, auditor has said the materiality level is 5,000. Now, question is that in that situation, some particular errors may remain undetected. Auditor will not be able to trace it. Okay, now what is the cumulative impact of this? Is it affecting? Let us say it affects the cumulative impact. Let us say maximum amount undetected will be 5 lakh. Since you are ignoring the transaction below 5,000, let us say entire thing contains mistake. Then the maximum amount of misstatement will be 5 lakh rupees. Let us assume. Okay. So now the auditor has to consider whether that is tolerable. Whether an error or misstatement worth 5 lakh rupees is tolerable. Or this is going to affect the overall financial statement. So auditor needs to assess that what is the probability that it will exceed the materiality of the financial statement as a whole. So as a whole, let us say auditor has fixed the materiality of the financial statement is 5 lakh. And at individual transaction level, it is 5,000. And auditor feels the probability of aggregate uncorrected, undetected misstatements will not exceed 5 lakh. Then it's okay. Auditor has perfectly set the materiality level because in worst condition also it is not affecting the entire financial statement. If applicable performance materiality, also if in certain situations, in some specific situations, this performance applicable performance materiality also refers to the amount or amounts set by the auditor at less than the materiality level or levels. Okay, in certain situation, it can also say that the amount which is set by the auditor at the less than materiality level, but provided you have to see it is for a particular transaction. That means it is a possibility. The auditor says that at transaction level, materiality level is 5,000. But for some items, let us say for something like this, something for interest item, when interest is paid and interest is received. So materiality level is 100 rupees. That means for transaction, for that transaction alone, materiality level is relatively lower. So auditor has set a materiality level less than the materiality level for all other transactions. So for a particular class of transaction or for a particular account balance, materiality level can be lower. Okay. Now, friends, so many things we have discussed about materiality. It may appear to be very technical, but lastly, we'll see only some guidelines because the concept of materiality has to be decided on the basis of experience. Of course, standard has tried to clarify what is the how for different class of transaction, different materiality level can be set. But right now, let us learn some guidelines which will be practically useful in deciding the materiality. Okay. So now this is the important thing for us. How we'll be deciding the concept of materiality. At this level, having understood this, then what is materiality, I think you have understood. Now, will you be able to decide what is the materiality level for a particular audit? Suppose I'm sending you the audit of a particular company. Go and do the audit of this. You have to set a materiality level. Now, what we have understood that overall you have to decide the materiality level for the entire financial statement. Or for a particular transaction, we might have to set a materiality level. Okay. Or for a certain class of transaction, we may also set a materiality level which is different. Yes or no? Now, question comes on what basis we'll decide those amounts. For deciding that thing, these guidelines will be helpful to some extent, but this is again not a formula. We may decide materiality on the basis of amount. That means if the amount is big, it is material. Amount is small, it is not material. That also has to see. That decision has to be taken, keeping in mind the circumstances of the case, circumstances of the business. Then statutory items of assets and liabilities, like let us say some tax payable or refund, tax money receivable. We may decide what is the materiality level. We may decide materiality level is any amount, maybe 1 rupee, since it's a statutory item. Legal item, even if 1 rupee is, let us say, missed out, then it is a material, it will affect the materiality. That means auditor has to pay more attention. Then items requiring disclosure. If there is some item when disclosure is required, we can consider that is material. Okay, so we may consider higher amounts are material, statutory items are material, items which requires disclosure are also material. And one more thing, any item of income and expenditures which exceeds 1% of the revenue from operations or rupees 1 lakh rupees, whichever is higher, that may be considered as material. This is again by referring to the provisions of Companies Act. This figure has been taken 1% of the revenue or 1 lakh rupees, whichever is higher. You decide what is the revenue, operating revenue, what is 1% or 1 lakh rupees, whichever is higher, that is material. Why it is so? Because Companies Law requires if an item exceeds 1% of the revenue or rupees 1 lakh, whichever is higher, that has to be shown and disclosed separately in the financial statement. So that one may keep in his mind to decide whether item is material or not. 1% of the revenue or 1 lakh rupees, whichever is higher. So we discussed so many things about materiality, but ultimately we may decide on these bases, on the basis of amount, whether it is statutory amount or not. Okay, 1% of the turnover or 1 lakh rupees, whichever is higher. Okay, so like this, on that basis, you can decide. This decision is important, or setting this materiality level is important because it affects auditor's performance at program level as well as execution level. Okay, friends, did you understand this concept? Yes or no? Or you are finding it too technical? Tell me honestly. Can you reply?
Understanding, sir.
Your understanding. Okay, thank you.